This is for educational purposes only and is not financial advice. It's no secret that history often seems to repeat itself.
And when it comes to the stock market, investors may perform mental gymnastics to convince themselves that this time it's different. In fact, a well-known investor who reportedly saw potential for considerable annual growth over many years called those the four most expensive words in the English language.
And he may have been right, because few things have the potential to empty a brokerage account faster than blind optimism dressed up as financial genius.
This brings us to a renowned trader. This trader, who is considered a pioneer of speculative trading, was the basis for the main character in a best-selling book, and is well known for reportedly finding potential opportunities by shorting markets during crashes. He once said,
"There's nothing new on Wall Street. There can't be, because speculation is as old as the hills." Whatever happens in the stock market today has happened before and will happen again.
There's a stock market bubble that nobody talks about anymore. It's a bubble that looks disturbingly similar to the potential current state of the market.
I'm not talking about the tech bubble of the early 2000s or the 2008 financial crisis. I'm talking about a bubble you probably have never heard of.
It was a bubble that, when it potentially popped, the damage was ugly. The market saw a significant crash, around 50% for illustrative purposes.
Many of the world's largest companies lost 60 to 8% of their value. Inflation surged from around 3 to 11%.
And the market didn't fully recover for 8 years. I'm talking about the popular 50 bubble of the early 1970s.
The story starts in the late 1960s. The United States had just ridden a 20-year economic sugar high following a major world war.
Because in the late 60s, people had money, they had confidence, and most importantly, they had blind optimism.
And why wouldn't they? The country had just been on the winning side of a major war, landed a person on the moon allegedly, and invented some popular toys.
From the end of the war in 1945 all the way to 1970, the United States stock market had gained over 350% for illustrative purposes.
This unprecedented bull run led to a new strategy in investing becoming popularized. It was known as investing in one-decision stocks. The concept was simple. Invest in companies so powerful and so dominant that you only had one decision to make when it came to investing in them: buy. These stocks became known as the Popular 50. The Popular 50 wasn't comprised of penny stocks or emerging tech companies.
It was comprised of blue-chip companies that generated stable cash flows. It included companies like a major beverage company and a fast food giant. Investors saw these companies as bulletproof, and because of this, the idea of ever selling any of these stocks was considered crazy.
Here's the thing about investing. If something sounds like a no-brainer with zero potential downside, it's almost always a potential financial grenade with the pin already pulled.
By the early 1970s, the Popular 50 stocks weren't just expensive. They were priced like gravity didn't affect Wall Street. But the never-sell mentality around the Popular 50 turned their valuations into numbers you only see in a fairy tale. For example,
a copier company at 49 times earnings, the fast food giant at 86 times earnings, and a camera company at 90 times earnings.
At the peak, the top 5 Popular 50 stocks made up around a quarter of the entire market, and the entire group made up roughly 45%.
Then came 1973 to 1974. The dominoes fell one by one, and reality came in and slapped everyone across the face.
This led to the stock market plunging around 50% between 1973 and 1974, which marked the worst bear market since the Great. And when the economy falls apart, overpriced stocks don't just correct, they can get obliterated.
In the Popular 50, the beverage company's shares fell over 60%. The fast food giant's shares fell over 70%.
The so-called one-decision stocks turned into one big financial obituary.
Investors who thought they were buying eternal growth stocks ended up trapped in a kind of financial purgatory for the better part of a decade. Now, if you're looking at the current state of the market and getting a slight sense of déjà vu, you're not alone. In fact, a famous author once said, "History does not repeat itself, but it does rhyme."
And while not identical, today's stock market undeniably rhymes with the one back in 1972. A group of United States tech giants, better known as the Leading Seven, now make up around 36% of a major stock market index.
That's right, 7 companies: a software giant, a consumer electronics leader, a search engine company, and a chip manufacturer carry the weight.
If that feels eerily familiar to the level of concentration we saw with the popular 50 companies, it's because it could be.
Yes, the leading 7 companies are innovative. But so did the copier company. So did the camera company back in 1972.
So what about the valuations of these modern-day tech giants? Let's just say they're also priced as if gravity doesn't affect them.
The search engine and social media firms trade at around 28 times earnings. The e-commerce platform at 35 times earnings.
Are these solid companies? Absolutely. Are they potentially overpriced, overweighted, and worshipped as if they're bulletproof? Also, maybe. And just like in 1972, investors might be telling themselves the exact same bedtime story. These companies are untouchable and will grow forever. All we might be missing is a couple of macroeconomic dominoes to fall, and we could be right back where we were.
Another famous investor summed it up best. What we may learn from history is that people don't always learn from history.
So here we are, once again, staring at a top-heavy market, pretending valuations don't matter, and whispering the 4 most expensive words.
If you learned something new today, subscribe for more simple finance stories. Educational purposes only, not financial advice.